Let me tell you about the most powerful financial account available to everyday Americans and why almost nobody uses it correctly. It is called a Health Savings Account, or HSA, and if your employer offers a high-deductible health plan, you have access to what financial experts quietly call the holy grail of tax-advantaged investing, not a Roth IRA, not a 401k. The HSA beats them both in one very specific and extraordinary way, and by the end of this video, you will understand exactly why. Let us start from the very beginning. A High-Deductible Health Plan, or HDHP, is exactly what it sounds like. It is a health insurance plan with lower monthly premiums, but a higher deductible, meaning you pay more out of pocket before your insurance kicks in. For 2024, the IRS defines an HDHP as any plan with a deductible of at least $1,600 for an individual or $3,200 for a family. The out-of-pocket maximum is capped at $8,050 for individuals and $16,100 for families. Now, if you just heard those numbers and thought that sounds scary, stay with me. Because the deductible is not the story. The HSA attached to it, that is the story. Every financial account you have ever heard of gets taxed at some point. Your regular brokerage account, you pay taxes on capital gains. Your traditional 401k, you defer taxes now, but pay them when you withdraw. Your Roth IRA, you pay taxes before you contribute, then never again, which is already excellent. The HSA does something no other account in the United States tax code allows. First, contributions are tax deductible. Every dollar you put into your HSA comes straight off your taxable income. If you are in the 22% tax bracket and you contribute $4,150, the maximum for an individual in 2024, you just saved yourself over $900 in federal taxes instantly. Second, the money grows completely tax-free. Unlike a standard brokerage account, there is no annual tax drag from dividends or capital gains. You can invest your HSA balance in index funds, ETFs, or mutual funds, and every dollar of growth compounds untouched by the IRS for as long as you want. Third, withdrawals are 100% tax-free, as long as you spend the money on qualified medical expenses. And here's the kicker. The list of qualified expenses is enormous. Prescriptions, dental work, vision care, therapy, chiropractic services, hearing aids, and even certain over-the-counter medications all qualify. Triple tax advantage. No other account does this. Not one. Most people use their HSA like a glorified flexible spending account. They contribute a little, leave it sitting in cash, and drain it every year on copays and prescriptions. That is the wrong approach, and it is leaving enormous amounts of wealth on the table. The right strategy, the one wealthy and financially literate people use, is this. If you can afford to pay your medical expenses out of pocket right now, do it. Pay your doctor bills from your regular checking account. Let your HSA balance sit untouched. Invest it in the stock market, growing tax-free year after year. Here is why this is so powerful. There is no deadline to reimburse yourself from an HSA. You can pay a medical bill today, keep the receipt, and reimburse yourself from your HSA 20 years later. The IRS does not care when you take the reimbursement, only that the original expense was qualified. So your HSA functions as an indefinitely deferred tax-free slush fund tied to every medical receipt you have ever saved. Think about that for a moment. You contribute $4,150 this year. You invested in a low-cost S&P 500 index fund. You pay your medical bills from your own pocket and file away the receipts. Over the next 25 years, assuming a 7% average annual return, that single year's contribution grows to nearly $22,000. All completely tax-free. Do that every single year and you are building a tax-free war chest that dwarfs most retirement accounts. Once you turn 65, the rules change in a significant way. You can withdraw money from your HSA for any reason, not just medical expenses, and you will simply pay ordinary income tax on it, exactly like a traditional 401k withdrawal. In other words, at 65, your HSA becomes a traditional IRA with zero downside. You still have all the upside, the tax-free growth and tax-free medical withdrawals, but you lose nothing if you need the money for something else. And consider this, healthcare is the single largest expense most Americans face in retirement. The average retired couple is estimated to need over $300,000 to cover healthcare costs in retirement. An HSA that has been growing untouched for 30 years could cover a staggering portion of that, entirely tax-free. That is money that never touches your taxable income, never gets eroded by Medicare premiums tied to income thresholds, and never gets counted against you in the way other retirement distributions can. Let us make this tangible with a straightforward example. Say you are 30 years old. You enroll in your employer's HDHP. You max out your HSA every year at $4,150, and you invest it entirely in an index fund tracking the broader stock market. You pay all your medical bills from your take-home pay and keep every receipt in a folder on your computer. Assuming a 7% average annual return over 35 years, by the time you are 65, your HSA alone would hold approximately $576,000. Every cent of that can be withdrawn tax-free for medical expenses, and at 65, the average American is spending significantly on health care. If you have been diligent about saving receipts, you could also pull out tens of thousands of dollars in tax-free reimbursements for bills you paid decades ago. Now layer that on top of your 401k and Roth IRA, and you begin to see the picture. The HSA is not a replacement for those accounts. It is a third engine running alongside them, powered by the most favorable tax treatment in the entire United States tax code. The most common concern people raise is this: what if I have a major medical emergency and I need the money? This is a fair question. The HDHP does come with a higher deductible, which means more out-of-pocket exposure in a bad year. But two things are worth noting. First, your employer's HDHP premium savings versus a traditional plan can often be redirected into your HSA, meaning you are essentially funding the account with money you were already spending. Second, the money in your HSA is always there as a backstop. If a serious illness hits and you need to drain the account for medical bills, every dollar comes out tax-free. You never lose the tax advantage on qualified spending. Some people ask whether the HSA is still worth it if their employer does not contribute. Absolutely. The tax deduction alone justifies it. A single person in the 24% tax bracket who maxes out their HSA every year saves nearly $1,000 in federal taxes annually just from the contribution deduction before a single dollar of investment growth is even counted. And for the self-employed, yes, you are eligible too. As long as you are enrolled in a qualifying HDHP, whether through the marketplace or a private insurer, you can open and contribute to an HSA and claim the deduction on your personal tax return. So here is how to get started. Step 1. Check whether your employer offers an HDHP option during open enrollment. If they do, run the numbers and compare the premium difference between the HDHP and your current plan. Step 2. If you are eligible, open an HSA. Your employer may offer one automatically, but you are also free to open one independently through providers like Fidelity, which currently offers an HSA with no fees and excellent investment options. Step 3. Invest the balance. Do not leave it in cash. Once your balance clears whatever minimum the provider requires, move it into a diversified index fund. Step 4. Pay medical expenses out of pocket whenever possible and keep every single receipt. A simple spreadsheet or a folder in your email works perfectly fine. Step 5. Let time do the heavy lifting. The HSA is the most underutilized tax-advantaged account in America. It is not talked about the way 401ks and Roth IRAs are talked about, but among people who truly understand the tax code, it holds a very special status. The triple tax advantage is genuinely unmatched. The flexibility after 65 is remarkable, and the potential to use decades of compound growth to fund a tax-free retirement healthcare pool is a strategy that costs you nothing except a little discipline today. If your employer offers a high-deductible health plan, open that HSA, max it out, invest it, and then leave it alone. Your future self, sitting in retirement with hundreds of thousands of tax-free dollars, will thank you. If you found this useful, subscribe and check out our video on maxing out a Roth IRA at any income level. See you there.